Welcome to TickerWatch. This week, we unpack a flurry of announcements from Tesla that have investors asking a fundamental question. Is the company's future about energy and robots more than it is about cars? While the company made a massive new commitment to solar manufacturing with an aggressive 2028 timeline, its energy storage division was quietly setting new deployment records. With all this happening as the company officially pivots away from some of its longest-running vehicle models, was this a breakout week for a new strategy or a sign of growing pains? You're listening to TickerWatch News for Tesla, Week 6, 2026. In this episode, we're covering the latest developments for the company, from ambitious new manufacturing plans and record-breaking energy deployments to the evolving strategy around autonomous driving and robotics. Stock Snapshot. It was a volatile week for the markets and for Tesla. After trading around the 419 mark earlier in the week, the stock saw sizable gains on Friday as part of a broader tech sector rebound. Still, the share price remains down significantly from its peak in December 2025. The Nasdaq and S&P 500 ended the week in the red, reflecting persistent investor uncertainty about the tech sector's heavy spending on artificial intelligence. While trading volume for Tesla trended with the broader market, the week's news cycle seemed to reinforce two competing narratives, one of a maturing electric vehicle business facing headwinds, and another of a high-growth technology company pivoting towards new ventures in AI and energy. Top news and headlines. The biggest story of the week is Tesla's major new push into solar manufacturing. The company is actively hiring engineers and scientists to support an ambitious plan to establish 100 gigawatts of domestic solar production capacity. A new timeline has emerged, with job listings stating a goal to deploy this manufacturing capability from raw materials on American soil by the end of 2028. Executives are reportedly evaluating multiple sites for this expansion, including its existing factory in Buffalo, New York, as well as potential new facilities in Arizona and Idaho. This move signals a significant acceleration of Tesla's ambitions in the energy sector. While solar plans grabbed headlines, Tesla's energy storage division delivered concrete results. The company reported record stationary battery deployments for the fourth quarter of 2025. Deployments grew 49% for the full year compared to 2024. This growth comes as the company's electric vehicle deliveries slowed, with the energy division reporting its fifth consecutive quarter of record profit margins. To meet the booming demand for its Megapack and Powerwall, the company confirmed production will begin this year in a new factory near Houston. In a move that formalizes its strategic pivot, Tesla announced it will discontinue its long-running Model S and Model X vehicles. The company stated this will free up factory capacity for producing its Optimus humanoid robots and for robotaxi production. The company is targeting 2026 for a broader deployment of these new technologies. Alongside this shift, Tesla also introduced a new lower-priced all-wheel drive version of the Model Y in the United States, priced at $41,990, in an effort to attract more cost-conscious buyers. And finally, on the autonomous driving front, Tesla's Vice President of Engineering, Lars Moravi, urged the U.S. Senate Commerce Committee to establish a federal framework for self-driving vehicles, stating that current regulations are inhibiting innovation. The company also shared that its full self-driving, or FSD feature, has reached nearly 1.1 million paid subscribers globally. The option to pay an upfront fee for the service is being phased out after this month, moving to a subscription-only model. In parallel, Tesla is expanding its robotaxi service, with plans to launch in 7 new cities during the first half of this year, including Dallas, Phoenix, and Miami. Market reaction and investor sentiment. The market's reaction to Tesla's strategic shift remains deeply divided. On the bullish side, Roth Capital Markets reiterated a buy rating, advising investors to purchase shares on any weakness, with a price target of $505. Analysts at Wedbush are even more optimistic, maintaining a base case target of $600. These bulls are focused on the long-term potential of autonomy, robotics in the energy business, viewing Tesla as a growth stock driven by these future catalysts rather than by current auto sales. However, the broader analyst community is more cautious. The consensus rating on the stock is a hold, with an average price target of around $400. This split is reflected in investor commentary, with some, like Ross Gerber, speculating about Tesla eventually merging into Elon Musk's other ventures, while others question the financial logic and potential dilution of such moves. One report from Simply Wall Street noted that community fair value estimates for the company range from as low as $70 to as much as $2,700 per share, highlighting the extreme divergence in how investors are pricing the company's future. Technical and fundamental check-in. From a technical perspective, the stock remains in a longer-term downtrend, trading significantly below its 52-week high set in late 2025. The $400 level has become an area of interest as it sits near the average analyst price target and has been a key level in options markets. Rallies like the one seen on Friday have so far been met with resistance. On the fundamental side, the company's valuation remains a central point of debate. With a forward price-to-earnings ratio in the high 100s, Tesla trades at a steep premium to the auto industry. A discounted cash flow analysis from Simply Wall Street suggested the stock may be significantly overvalued based on its current financials. For the full year of 2025, Tesla reported its first-ever annual revenue decline, with profits roughly halving from the previous year. This underscores the argument that the bull case for the stock is no longer about a quick rebound in vehicle margins, but rather a long-term bet on the successful execution of its pivot to AI, robotics, and energy. What to watch next week? Looking ahead, several catalysts could influence the narrative. First, the deadline to purchase FSD software with an upfront fee is Valentine's Day. The market will be watching to see if the shift to a subscription-only model affects adoption rates. Second, expect more details on the ambitious solar manufacturing expansion. Any announcements regarding factory locations, partnerships, or specific timelines for the 100-gigawatt goal will be closely watched. Third is the operational progress on the robotaxi rollout. With plans to launch in 7 new cities in the first half of this year, any updates on regulatory approvals or service launches will be a key indicator of the company's execution on its autonomy goals. The bull case for the coming months is that Tesla shows tangible progress on its 2026 deployment targets for robotaxis and Optimus, while the energy business continues its high-margin growth. The bear case is that a continued slowdown in EV demand, coupled with delays in the AI and robotics pivot, could cause investors to reevaluate the stock's high valuation. For now, the base case is continued volatility as the market weighs the challenges in the auto segment against the unproven but high-potential new ventures. Thank you for tuning in to TickerWatch. The information in this podcast is for educational purposes only and is not financial advice. Be sure to subscribe, leave a review, and share this episode. We'll be back next week with more updates.